Todd, thank you for joining us. I'm curious, this news that broke just the other day, Nexstar acquiring Tegna, total deal with debt is 6.2 billion. Are we going to see more of this? And if we are, why?
Certainly, I think we need to expect this for a couple reasons. First off, streaming is putting tremendous pressure on the broadcasters. And so if they're going to continue to remain competitive, they need to find a way to help increase their operating margins. And one of the ways to do that is to combine with other broadcast stations and help combine overlapping services so that they can unlock value, maybe lower some of their costs, and that could help increase some margin. Number two, just the other week, we saw probably one of the biggest regulatory rollbacks in history through the FCC for communications. And so what that's doing is that's lowering basically what was limiting factors, right, or thresholds that were preventing companies like this from getting together, because there were a lot of antiquated rules in there that were preventing companies from having too much of an exposure within certain markets. Okay. And so when that happened, that opened the door for Nexstar and Tegna to actually combine and work together. So I think with this regulatory rollback that we're seeing, that's opening the door for other broadcast stations to combine together and take advantage of what they realize they need to do.
So let me ask you some questions breaking down what you've just said.
Sure.
So let's talk about the efficiencies, as I think people on Wall Street would talk about. Nexstar or Tegna in the press release talked about savings of $300 million. I used to work at a Tegna station. I was in local TV for a while. What I hear when I see $300 million in savings are layoffs, because you're going to have duplicative positions. For instance, in Buffalo, Channel 4 is Nexstar, Channel 2 is Tegna. And why would you need two individual newsrooms? Should those people be wondering about their role in the future?
Unfortunately, I think so. That's where a lot of this cost savings is going to come from. And there's obviously technological cost savings that's going to happen, but a lot of it is overlap with people that are being employed by this. And they're going to realize that they don't need the same people in the operations across all these different areas, especially when you're talking about being in the same exact market as another place. So, yep. I think that's exactly something that they need to be concerned about, which is an unfortunate byproduct of what we're going to see here. And it's not unique, though, to communications, right? This is something that we see with any kind of merger, right? When we come together, there's a question of who's going to be redundant to, the new organization and who's going to be essential to being kept around.
So let me use the Buffalo model. Tegna will own Nexstar will own Channel 4, and they will own Channel 2. How are they going to make money? If everybody's shrinking, how do you make money? Because the pie itself is shrinking.
Yeah. Well, I think what happens is that you can turn it more into from individual stations, more into a platform. And so what can actually start to happen is that you can start to have those stations work a little bit more in unison with each other. And so, I mean, I always approach this from an investment perspective. You're going to be more of an expert about how the stations themselves are actually working on the inner side of it. We'll probably give a little bit more context from it. But I think what you've seen and been the success of streaming is that you have a platform, right? And the streaming services have been so successful because they're utilizing a platform. And I think that that's what you're going to potentially see across these different stations. Now, the difference is, though, right, what you have in these local TV stations that you don't have on streaming, especially if you're talking about a market like Buffalo, right, is you're talking about local news, right, and more local stories and more local engagement. And how can you start working together to create the platform that's focusing on that? And that's where the broadcast stations are differentiating themselves from the streaming services.
So I would say no. For instance, Channel 4 Buffalo, Channel 2 Buffalo. Right now, they produce the same product. They both do TV news. That's going to get merged. Is Buffalo big enough to sustain a digital platform that differentiates between Channel 4 and Channel 2? Or you just combine everything? And even if you do combine it, how do you generate the revenue via digital to sustain it?
How do you generate the revenue via digital to sustain the combined stations?
Is going to be the platform, because Buffalo, the DMA, the market itself is maybe 1.1 million people. I understand streaming working on a nationwide scale, but let's look at Cleveland. In Cleveland, Nexstar will own Channel 8 and Channel 3, and Nexstar already owns independent Channel 55. How do you take a market like Cleveland, roughly 2 million people, and generate revenue from streaming that sustains that? It's just 2 million people. How does that model work?
I think really it goes back to what we were talking about earlier, right? To really make this successful, it's coming from a cost cutting perspective. The platforms are part of it, but the cost cutting and improving profit margins. So maybe you see those channels collapse on each other. Maybe they differentiate them. Maybe they don't start to serve the same thing that they do today. And, channel 55, I think you said, versus channel 2 versus channel 4 start to look different in what they're doing. And I think that that's maybe the way you could look at it from a platform perspective. Maybe each of them is doing something different. They're differentiating that and they're serving more of a market instead of having all that overlap, right? Maybe that's the way they're doing it. And they're doing that with a consistent operations back office and, obviously laying off some people potentially.
And now, from an investment standpoint, if I'm looking to invest in Nexstar, because they're the money in this thing, they're taking on debt to do it, but they've got a huge purse right now. Their wallet is fat. But going forward, what's the time horizon for them to exact the efficiencies, the layoffs, and the shrinking and the restructurings? And then how long till we get a picture as an investor of whether it's sustainable? Or am I buying, if I invest today at a top, that I'm not going to be able to recover?
I think that it takes time. What ultimately happens when we see most mergers is that we see these things happen in phases. Or in this case, a purchase, right? But you are merging two companies here. What happens is that we see these things happen in phases, right? And ultimately, we see an evaluation phase where often things don't happen because they're trying to really kind of look under the hood and sort things out, right? Because there's certain things you don't see until you're actually combined and you're working and you're one company. I think ultimately what will happen is that, starting around that 6 to 12 month period, you start to see little subtle changes take place, consolidation of certain services, things of that nature. It's once you start getting to that 12 to 18 month period with a lot of mergers and acquisitions, you start to see layoffs happen. You start to see scaling back. That's really at the time when people can start to evaluate what's going on. But ultimately, we also see natural attrition with a lot of these situations where people decide to move on. Now, these two companies are going to earn a large majority of the market. So more than likely, people who are moving on may have to move on to streaming themselves or may have to move on to potentially different careers depending on what their roles are, within the space. But I think ultimately it's that 6 to 18 month mark that you really start to see these things putting in place. And then it starts to become optimizing it, from 18 months on.
So again, from the investment standpoint, I understand how to buy stock directly, but are there ways that I, as an investor, if I think that Nexstar can turn this around, and as a former TV person, I'm skeptical, but if they can turn this around, are there ways that I could invest without directly buying Nexstar? Are there ETFs or things that follow this kind of consolidation where I can, control my exposure and get out quickly if I need to?
Yeah, I mean, one of the most easiest ways to do that is probably through the ETF that we run, which is a free markets ETF. That's ticker FMKT. We identified Nexstar back in June when the ETF actually started trading live, and that was one of our first holdings. And even today, it's still one of our largest holdings. So we still believe that there's value potentially with it, within this company, and really. It was all based on this objective, right? And this identification of companies that could benefit from deregulation and unlock value through that. And Nexstar had the financial wherewithal to be able to do that. And now we're starting to see the M&A or the consolidation right now. And I think that's that story playing out. And so I still think there's value. The question is, how much more are they going to go after? And like you said, can they unlock value? And I think that's a little bit of a tough situation to start to look at and constantly evaluate, because sometimes you don't know until after the fact. So one of the ways that we try to approach it from not just a fundamental standpoint, from also a technical standpoint. So we're trying to look at whether, basically what the price action of the stock is doing, because, an insider actions, right? So if we start to look at what insiders are doing, we start to look at the price continues to rise, right? Technicals lead, price leads, and fundamentals follow. So often what we can take a look at is the stock is continuing to rise. Investors believe, and that's what sometimes is the most important thing. Investors believe that there's more value to be unlocked from this kind of situation. Ultimately, if we start to see a rolling over of the stock, or we start to see the price shift, whether or not more value can be unlocked or not, investors have lost confidence potentially in the stock. And sometimes that's just enough to, make some of these things fall apart, or at least the stock price not continue to work for you, right? Because there's a difference between the stock and actually what's happening at the company sometimes.
And in fact, you had a technological heads up that this was coming down the pike because you used AI to create, if I've got this correct me when I get it wrong. You used AI to create the ETF, or the platform by which you then created the ETF and the decisions for investing or not?
Yeah. So what's happening is the pace of deregulation and the magnitude and length of these rules, right? I mean, some of these are very comprehensive, a lot of words. I mean, you look at the one big beautiful bill. I know we're not talking about that, but you know, that's a big thing. Even this FCC ruling that came out, rolling back, I think it was something like 98 different regulations. To really go back through these things, it would take a person a very long time. So what we have to do is we have to start leveraging AI to read and understand these documents, and then being able to utilize AI to go link them back and make these connections back to these certain companies. Interestingly enough, AI is very good at sorting and recognizing patterns. And so ultimately, what we were seeing undertones of this within certain legislation, within certain conversations within Washington, and the AI was able to pick up on those subtleties of it. Now, at the end of the day, it's not an AI driven portfolio. So the portfolio itself is not being constructed by the AI. It's still humans making those final decisions. But AI, like a lot of people, is helping us understand, what the information is, how to sparse it, and how to connect it back to what the investable trends are.
When you look at these investable trends, does the AI give you a hypothetical of whether the FCC will approve this merger? I mean, you're going to have stations or cities like Cleveland where they will control, Nexstar will control 3 stations. In other places, they will control the ABC, CBS, NBC affiliate. Is the FCC going to allow that, or will there have to be some selling of some of these stations to meet some kind of criterion the FCC?
Yeah, I think in some cases, right, I think the number they're talking about is like 80% in some of these markets. And so there may be a divestiture of some assets, so to speak, to help get this deal through. So whether or not we're using that to calculate a probability is not necessarily the case of what we're doing here. It's more identifying those trends and what the possibilities are and what those markets are. So we can go back and we can start to calculate what those probabilities are. But I think AI is not really, they're identifying a trend, right? They're identifying a momentum, right? And that's what helped us identify it initially. It's kind of looking at all these little pieces of news and how they're coming together. And so with this kind of situation, I don't think that we have, under this new regulatory rollback, I don't think we have enough precedent to actually understand what the probability is. Because if you go ask AI to calculate the probability of what was happening, you would be using a lot of old precedent, right? That is very outdated. And so I think it'd be very, very difficult to go accurately predict that kind of situation. But what we do see is that the environment and the regime that we're in is more favorable than it would have been in the past. And so that is increasing the probability. It's making it actually possible, but giving us an actual probability, I don't think would be reliable, even if it did.
So if Nexstar has to sell off some of these stations, there are still, Sinclair tried to do a deal with Tegna. Who buys the stations, and who else do you see perhaps coming together, and who might be the next target for Nexstar? Has the AI given you insight into that?
I mean, you're going to have to look at some of the bigger stations that are out there, right? And you're going to have to look at the competitors, because I think what's going to happen is that you're either going to have a bunch of the larger stations that are going to start to get together, right? Or I think that you're going to have larger stations start to take on a bunch of smaller ones, right? I think that when the AI is looking at it, or we even start to break it down, I think that you look at Gray Television, like you said, Sinclair. Those are probably 2 of the other major players within that space. So the question is, do they try to go together, or do they try to buy up little pieces, at a time, in markets that may be underutilized? I don't think that they try to compete head to head with Tegna and Nexstar, just because they're going to have such a market share, but maybe they buy those assets, like you said. I think that's the biggest thing, and we have to still evaluate what that looks like, and dig a little bit more on how those things, and wait for some of this news to continue to develop. Realistically speaking, AI is a good tool to help us get information quickly, but it's not it's not an end all fix all. And at the end of the day, we don't always want to try to be too predictive, right? We want to try to react a little bit, because you have to let the prices work a little bit, right? And then respond to that.
So let me recap some of the headlines here from an investor standpoint. This coming together will lead to layoffs because that's where you're going to increase the margins or at least maintain the margins for profitability and for revenue. So that's one headline. The other headline is that Nexstar and the people investing right now, whether it's in your ETF or in Nexstar, believe that they will make money in the future, whether it's from those efficiencies, those layoffs, or that there'll be enough advertising revenue and whatever the, what do they call it, the cable retransmission fees, whether that's through a streaming retransmission or not, that'll be enough to generate revenue. Will it be on the scale that we see with linear cable today, or is it going to be a smaller revenue pie?
So I want to take a step back on that last point that you made, right? Because I believe there's profit to be unlocked, right? And now the market's readjusting to that. If you look at the stock price of Nexstar has rallied pretty aggressively since this FCC ruling has come out. Okay. And obviously what's happening today is we're seeing that price up. Usually when you see these deals, actually, a company like Nexstar would trade down, right? And Tegna would actually trade up, right? As being bought out. Mm-hmm. So usually that's kind of the arbitrage that we see within this, but Nexstar is actually trading up today, which tells you that the market believes that there's still more value to be unlocked. And at the end of the day, in my opinion, and when we usually look at opportunities to invest, the market believing that there's more profit is almost more important than the actual expectations of there being profit within the company. Because again, it goes back to that kind of prices lead, fundamentals follow, right? The market's really a reflection of what the broader investing public believes and what the future growth opportunity is, or at least what the market believes that future growth opportunity is. So for us, we have to be behind the ability to capitalize on that. And so I think that that's what's the most important thing, to focus on what the market's looking at and what the investors believe. And that's where the value lies.
And what I'm hearing, look, I care about the people who I worked with in Buffalo and in Cleveland. But what I'm hearing you say is the market's betting that there will be value unlocked. Is it betting that there will be value unlocked because of new revenue streams or because of the efficiencies of combining forces and cutting out what some people would call the fat?
Cost savings. I believe it's operational efficiency and cost savings. I don't know how much there is to capitalize on new revenue streams, because I think that's where you're seeing it's going to be difficult to compete with streaming in that capacity. They're really taking it there. And so it's operational efficiency. That's really what I think the focus is right now. We don't know what the future is going to hold, though, Adam, right?
Right.
What the future hold, what new technologies come down, and the companies that have the best balance sheets, have the best margin, they're going to be the ones that are best positioned to capitalize on that. So I believe that it could be that, but the immediate focus is cutting redundancy.
So for investors, there's money to be made, but for the people I care about, don't let your children go into television. Is that basically what we're talking about here?
I think broadcast television in the short term is going to be tough.